the first webinar for 2016. We want to start this year with education. We want to educate you. We want to guide you for the best possible result in forex. Let's see whether we are ready. Yes, Bob. Good luck. Okay, I think we can start. Let me start the slides. If you have any questions at the end, you can ask me. This webinar will go approximately 40 minutes. So the remaining 20 minutes, it's going to be for answering any questions that you may possibly have. So we are ready. Okay, let me fix the slides. All right. Introduction to the fascinating world of forex. It is indeed very fascinating to trade the markets, but at the same time, it can be a nightmare if one person doesn't know the basics. And forex, it's something that we should constantly learn and learn and learn. We should have always a low profile and understand the basics so that we can move on to the actual strategies, which we are going to see in the upcoming webinars. On Friday's webinar, we have the webinar of trading like a pro. There, you are going to see strategies that they can provide you with very good and consistent results. But let's go to our webinar. As you can see, we have also a risk warning, which is one major philosophy of Argusfx is transparency. So we want to always have our traders being familiar with the risks involved when trading the markets. To start with, I would like to make a fast introduction of our today's host, Argusfx. Argus, as most of you already know, it's an STP ECN broker, which means that the company benefits from clients' trading volume. The company, in other words, it's not a market maker. The company benefits from a win-win situation. You win, the company wins in commissions. And this is fair enough. And this is Argusfx. Some of the benefits of the company, among a variety of benefits, is that it's offered the MT4 platform, customer protection, regulation, which is really important, your broker to be regulated, no charge on deposit and withdrawals, instant funding and withdrawal, multilingual support, helping the traders in different languages, expertise, private coaching, financial updates, and what the majority cares, security of funds. You want to know that your funds that you are about to invest or trade, they are secured. And the conclusion is that an STP or an ECN broker is the first step to fairness, because you want to trade with a good broker, right? So this is just an introduction of Argusfx before we actually move on to our presentation for today. The topics that we are going to go through, to most of you are familiar, but you will realize that we are going to point out the major elements of each topic that will help you to get the major idea of the forex market before placing your first trade on the platforms. So we are going to go through what is the forex market, time zones, what is forex trading, and many people, guys, they confuse what they are buying or selling. And it's something that it can happen. But in this webinar, we are going to demonstrate exactly what are we buying and what are we selling when it comes to currency pairs. What is the base currency and what is the second currency, or otherwise known the counter currency. The ask price, the bid price, that pairs fluctuate in pips, so we profit or we make losses depending on the fluctuations of a currency pair in pips. How do we convert these pips into funds? Because at the end of the day, you trade to make money. What is the spread? And an example on how to identify the spread. Margin and leverage, which is a crucial factor in forex trading. A lot of people, they leverage their trades in such a way which at the end of the day, their account balance disappears. So we are going to go through an example of what is margin, what is leverage, and how should we deal with it. And at the end, risk and money management, a theoretical aspect of this topic, since, as you all know, this webinar is an introduction. We are going to go in more details in the upcoming webinars. So let's start slide by slide to see what we're going to talk about. So the forex market, as you have seen, we have highlighted in green the most important parts, the theoretical parts of the forex market. The forex market is an online market for trading currencies. So whenever you are, anytime, as long as you have internet connectivity, you can trade. But of course, some traders, they overdo it. And the more they trade, taking advantage of this online availability, then the more they either lose or gain. But the most important thing is that you can trade online. The forex market has basic characteristics. High trading volume is one of the most volatile markets that exists out there. 24/5 operation. Dispersion through the internet. Anybody can trade from around the world. Traders use leverage, and this is the difference which brokers have from banks. Brokers, they give you the opportunity to trade in a way that you can maximize your balance 10 times and 20 times more, depending though whether you have the right strategy to do so. Whereas if you go to the bank tells you, for example, you've deposited $10,000, you know beforehand that the interest you are going to receive at the end of the year is a given percentage. Whereas through a brokerage firm, you can multiply your initial investment depending on the strategy and the game plan you have. Brokerage firms provide online platforms for trading. So you can see the most common platform is the MT4. And traders can speculate the markets anywhere and anytime. And this comes at the very first bullet point, online. Since it is an online market, you can trade anywhere and anytime. Here we have some time zones. We have 5 time zones, the Frankfurt, Germany, London, Great Britain, New York, United States, Sydney, Australia, and Tokyo in Japan. You can see the opening and closing times in Eastern European time. Eastern European time, since we are in Cyprus now, the time is 5:11, so Eastern European time, make the calculations. It's, for example, if you see the New York one, 3 p.m. is 3 Cyprus time, 11 p.m. is 11 Cyprus time. And you can use the time zone converters to find out the actual time zones of your choice. Okay. Now to the most important part, where many people confuse. Now, what is forex trading? Is the buying and selling of one currency against another. And the most common example we can use is the euro and the dollar. So the euro and the dollar, they make one currency pair. The euro, EUR, denotes the base currency. So the base currency is the first currency of the pair, whereas the USD denotes the US dollar, the second currency of the pair. And this is the most important part. We always buy or sell the base currency. So our main focus when we are making a prediction or a speculation, we focus on the base currency, the first currency of the pair. And thereafter we speculate the price movements of the second currency. The base currency has the value of 1 always. So you can see when you trade on the MT4 platform and you have, for example, the euro dollar, the euro is always 1. And you see the fluctuations of the US dollar. So the figures you see on your right on the platform, it's the value of the US dollar, which fluctuates up and down compared to 1 euro. A lot of people tend to confuse this, and it's not something which it's bad or it's just to point out something, but it's very important to know that we always buy or sell the base currency. Okay, let's see some examples of the base versus the second currency. So as we said before, we had the euro dollar, one currency pair. You can see here some other currency pairs, for example, AUD CAD, which is the Australian dollar. In this case is the base currency, and the CAD is the second currency of the pair. Similarly, we have the GBP USD, which is the sterling versus the US dollar. So in this case, the sterling is the base currency and the US dollar is the second currency. We have the EUR JPY, which is the euro versus the Japanese yen. We have GBP CHF, which in this case the base currency is the sterling and the second currency the Swiss franc. We have the EUR AUD, which is the euro, which is the base currency, and the Australian dollar, which is the second currency. And last but not least, we have the CAD CHF, the Canadian dollar, the base currency, and the Swiss franc, the second currency. So you can see that every currency pair is made up of the base currency, which is the first currency of the pair, and the second currency, which is the second currency within the pair. The second currency has also another name called the counter currency, but in more simpler terms, we have the base currency and the second currency. Hope everything is okay until this moment. Hold your questions, and anything you want to ask, you will have plenty of time. Okay, Now, another aspect of trading currencies is the ask price. So what do we mean when we say ask price? The ask price is the price which we can buy a given currency pair. So you can see on your platforms, and we're going to have a webinar separately for the MT4 platform with screenshots so you can understand with a wider picture how the MT4 platform works. But as I said, in this webinar, we will just introduce the essentials of Forex market. Let's take the example of the euro dollar now. In this case, if we have the ask price, it means that we are buying euros and we are selling the dollars, but you don't care about selling dollars. In this case, when we ask, we only care that we are buying euros. So in this case, if we are buying euros, we are buying the euro dollar, we are buying the pair. So when we say buying the euro dollar, it means that we are buying euros because we expect that the euro will gain value over the US dollar, which means that the euro now can be exchanged for more US dollars. So in this scenario, in case that the prediction went wrong and we bought the euro dollar pair, which means we bought euros, the price on the chart rises and we have bullish volatility, we have a bullish trend. You can call it any names you wish. So in this case, the ask price, just to summarize this slide, is the price that we can buy a currency pair. And in this example, we have the euro dollar. So when we buy the euro dollar, we are buying euros with the expectations that the euro will gain value and it will give us more dollars if we exchange it to dollars. And the price on the chart rises. Now we have the other case, the bid price. So this is the opposite of the ask price. The bid price is the price which, as a trader, I can sell a currency pair. And let's take again the example of the euro dollar. If we are selling the pair, if we are selling the euro dollar, it means that we sell euros. And why do we sell euros? Because we expect that the euro will lose value over the US dollar and that the euro can now be exchanged for less dollars. And in this scenario, if we predict that we are to sell the euro dollar, the price is expected to drop. So you can see the price on the charts that it will start dropping to the downside. And we have the so-called bearish volatility or bearish trend. So the main difference, as you can see, of the ask and the bid price is that when we have the ask price, we buy the base currency, which is the euro. And in the bid price, if we believe that the pair will drop, we sell the euro dollar. We are selling the euros. And this is the most important thing to understand. And I will repeat it without any problem, that we always buy or sell the base currency in a pair, always. Okay, let's see some examples here that the pairs, they fluctuate in pips. So we are buying or selling, we are bidding or asking, so that we can make some pips, because it's the pips at the end of the day that tell us whether we were right or whether we were wrong in our prediction. A price change of 1 cent defines a movement of 100 pips. Similarly, a price change of half a cent defines a movement of 50 pips. Traders therefore gain or lose money in pips. Let's see this table that we have at below these theoretical sentences. We have the euro dollar. So let's assume that the euro dollar escalated 50 pips. So it went up 50 pips. It means that from a hypothetical price of 1.3000, the price risen to 1.3050. So this is a rise of 50 pips to the upside. So if I was a trader and I was to buy the euro dollar, I would have won 50 pips. In the second line, we have the euro dollar having made a 20 pips drop. So in this case, if the price was 1.3000, the price would have dropped to 1.2980. Similarly, a 100 pips rise from the same price again. To make things simpler, the new price would have been 1.3100. The same here, we have 30 pips drop. So if the price was 1.3000, a drop to 1.2970 would have represented the drop of 30 pips. And finally, 150 pips rise will mean an appreciation from 1.3000 to 1.3150. So in this case, let's take the first line. If we were to buy the euro dollar, and the euro dollar made a rise of 50 pips, we would have won 50 pips. In the second line, a drop from 130 of 20 pips. If we have made a correct prediction and we bidded the pair, we sold the pair, we would have made a 20 pips drop. Maybe these things, they seem a bit easy, but it's very, very important to start to have the major and basic idea of the pips too. Let's move on. Okay, since we have identified now that our profits and losses depend on the pips, our main objective, as we said in forex, is to make money, or at least to be profitable for a period of time and generate some additional income for those that they do it part-time, or for those who are professional traders to generate a long-term stable and consistent cash flow. So the pips gained or lost are converted into funds. The volume or investment size is measured in lots. So now let's see how the pips are converted into funds, into money. Let's see this example here. Again, the same example on the euro dollar. If our prediction was right and we have bought the euro dollar, which means we have bought euros because we expected that the euro will gain value over the US dollar and it will give us more dollars, and we've made 50 pips. If we have invested 0.1 lots, which in the case of the euro dollar is $1 per pip. So every time the euro dollar moves 1 pip, we either lose or win $1. But in this example, let's assume that we won 50 pips. And with an investment of 0.1, which means $1 per pip, we've made $50. It's $1 per pip times 50. In the other scenario, where in this case we have lost 20 pips because we made a wrong prediction, and we had invested 0.3 lots, which means $3 per pip, would mean that we've lost $60. $3 per pip times 20 losing pips equals to minus $60. Let's move on to the third one. Assuming that we have won 100 pips with a lot size of 0.5, which means $5 per pip, we would have made $500. Similarly, in the opposite scenario, if we lost 30 pips, but in this case we have invested one lot means $10 per pip. And you can see here the big difference. By investing $10 per pip and having lost 30 pips, we are minus $300, because the more we increase our lot size, the more the probability is that we will either lose more or gain more. And finally, again, a successful scenario, let's say, with the euro dollar, we made 20 pips, but in this time we have invested 1.5 lots, which means $15 per pip. So since we won 20 pips, we made $300 of profit. So what you can realize here is that the pips is what define at the end of the day the money, the funds which we are going to make or lose. So it is very important to apply appropriate risk and money management, invest the necessary and the correct lot size based on your balance. And once again, everything that has to do with risk management, how to safeguard your capital, how to apply appropriate strategies, we have the next webinars, one by one, and everything will be clear in your mind. And since I'm talking also about the other webinars, we have a list of 19 webinars just for you to have as much as possible a better picture of the forex market. Okay, let's see now. Now the spread. So it's really important to also understand the spread. So again, in the euro dollar, in the scenario where the bid and the ask price on the euro dollar are 1.2999 and 1.3000 respectively, just to make things simpler, this difference represents a spread of 1 pip. So for your broker to allow you to trade on their platform, they have to make some commission. It's very logical, and it's the correct way that things should be done. So this difference is the spread. So in this situation, let's say, we have a spread of 1 pip. But let's see now, when do we start making a profit? Assuming that a trader bought the euro dollar at 1.3000. So this is the ask price, which we have talked in the previous slides. Then the bid price, 1.2999, should move above the 1.3000. So when you believe, let's say, that the euro dollar will go up, and you buy the euro dollar, meaning that you buy the euros at the price of 1.3000, then the bid price, which is always lower than the buying price, should go higher, so you can start first covering the broker spread and then making a profit. On the other hand, in the event where the trader sold the euro dollar at 1.2999, what will happen now? The ask price, 1.3000, should move below the 1.2999 level to cover the broker spread. So when we are selling, the ask price is always above our selling price. So we first need to cover the broker spread. So the ask price should move below our selling price to cover first the broker spread and then start making a profit. Okay, now this is the most important part when it comes to trading the markets: margin and leverage. A lot of people, they tend to use too much leverage when they are trading, and it happened to all of us in the past, and it can happen anytime. Sometimes traders, they want to take advantage of this leverage for a good purpose, to increase their money in their trading account. They invest more than what the account can hold, and then boom, zero. So where is the main error which takes place here? Is over leveraging. When you over leverage and you invest more than what your account can hold, then the likely result, it will be that your account will go to zero. And once again, you are going to be in the beginner cycle. We all pass through this. The beginner cycle is a cycle where you all the time say to yourself, I will change. I will not do this again. You deposit, you do the same thing again. I will not do this again. You deposit and you do the same thing again, which is not something that you should be criticized for, or we should not be criticized for this. Why? Because through mistakes, you are learning. Through mistakes, you are getting more and more deeper into the markets. Because if you don't make a mistake, it means you have never tried. Yes? All right, so let's define what is margin, what is leverage, and give this example we have underneath. So margin is used to keep a trader's orders running. Is this percentage you can see on your platform, which tells you, for example, that this is a percentage that allows you to keep your orders running, and is like a signal, an alert, whether to deposit more in case that your account is in danger, or if your account is increasing in funds, your margin is increasing. Leverage allows the trader to take control of bigger size orders, which is the example we have given before. If you go to the bank, let's say, the bank will not give you leverage. The bank will tell you you've deposited, let's say, $1,000. At the end of the year, this is your interest. The opposite, though, happens with brokers, and especially with ECN and STPs. They care for their client to deposit and play safe, invest safe. Because if you invest safe, it's a win-win situation, correct? So the difference of leverage is that your bank will give you a predetermined interest received at the end of the year, whereas through brokers, you can multiply your amount because of leverage. It's like a form of indirect loan that you get from your broker, to allow you to trade more than what you actually have in your account. Okay, let's see this case study, and which shows the importance of leverage, and that leverage should be used the right way. Let's assume we have trader X and trader Y. Both have an account capital of $10,000. Trader X leverages his account with 50 times the equity, which means that he invested notional amount, hypothetical amount, let's say, of $500,000 because he risked 50% of his capital. So 10,000 times 50, it's a notional funds, hypothetical funds that you actually don't possess, but you are allowed to trade because of leverage, $500,000. Trader Y has the same amount of capital, but he's a more conservative trader or investor. So he uses a leverage of 5 to 1. So 5 times 10,000 is 50,000 hypothetical funds. Now, in the worst case scenario, because when you trade, you should always have this in mind, to minimize your losses. This is your priority, not how much you will make, but at first to minimize your losses, and then if the market goes to your favor with your strategy, to acquire as much as profit as possible. So in this case, if both traders have lost 100 pips, it means that trader X lost half of his balance. Half of his balance, let's say, out of one trade. But because trader Y was more conservative, he wanted to have an account for the next day too. Because you know, traders, most of the time, people believe that there is not going to be a next day and they want to make money today. Or when Friday comes and they say, oh my God, I have to trade today because it's weekend. What am I going to do? The markets are closed. I want to make profits on Friday, so I relax on the weekend. I enjoy myself. No, it's better to be conservative, invest the right way, correct leverage, and then you can have your happy holidays. So trader X lost 50% of his equity, whereas trader Y lost 5%. So trader Y, he can trade the next day. Trader X has an equity remaining of 50%. Half of his capital is gone. Whereas trader Y, he has 95% of his capital left. He made a wrong trade. Okay, no worries. There is next day, and next day is to trade. So you can see here the difference of leverage. If you use too much leverage, it can go against you should the trade goes wrong. Yes, so it's very important to trade according to your account capital. Do not overtrade. Do not use too much lot size. Trade accordingly. I will tell you that if you have $1,000 balance, you trade 0.1 lot. Safe. This is very safe. If you have $5,000 balance, trade 0.5. Again, it's safe. It gives you the chance to fix your mistakes, to see what went wrong. Because many traders believe that they can actually predict when the price will drop or go up. What you can predict is the trend, but not the exact entry point. That's why by using safe leverage and by believing into your strategy, at the very beginning you enter your trade. Maybe there is some turbulence at the beginning, maybe it goes a bit against you, but if you have invested the right amount of leverage lot size, then you have nothing to be afraid of. Since you have traded with the trend, it will come back and it will go to your favor. But if you invest more and more and more, it means at some point you will lose the control, and what will happen is something which nobody wants. Nobody wants the account balance to go back to zero. It's psychologically disturbing, and I can understand your concerns because I have gone through these things in the very past at my early stages when I started to trading the markets. I hope you understood this slide. Nevertheless, we are recording this webinar, so in case you want to have a look after also anytime at your own pace, no problem. You can ask us any questions anytime to help you. And the final part, which is just the theoretical part, and most of you already know these two tools for managing risk. Risk and money management is a critical concept used for maintaining long-term consistency, because you want to last in the forex market, not just to have an account for 1 month or 2 months and then boom, back to the beginner cycle. Statistically talking, on average, the majority of accounts, if the traders are not using the appropriate risk and money management, they go only for a period of 3 months and then back to zero, and again the same cycle over and over again. So the two most popular tools to manage risk are stop loss and take profit. The stop loss is used to cut losses, which is very important. Is the most important tactic you can do to cut your losses short in case your prediction was wrong. And the take profit, which is used to lock the gains. So let's say you enter into a trade, you place your stop loss. If it hits your stop loss level, okay, nothing happened. It was just one prediction gone wrong. You have a lot of predictions to do, a lot of orders to execute. Whereas the take profit, should your trade goes well, you capture your profit, you are happy, and your balance increases. And last but not least, the volume size, which, as we already said, is measured in lots, is a major money management parameter for capital exposure. So at the end of the day, the most important things that we should all know when trading the markets is that currency pairs are there to give us the opportunity to benefit. Currency pairs are made up of two currencies, the base currency and the second currency. And we always buy or sell the base currency of the pair. The ask price is a price that we can buy a pair, whereas the bid price is a price which we can sell the pair. Most important of all, again, is the leverage, and to understand the importance of trading safe. I would like to thank you for your time. I hope I didn't talk too much, but I wanted to explain as much as possible and very clear the introduction of the forex market and the major ingredients that all traders should have in mind. Let me see if you have any questions. Okay, why does my platform shows pips instead of we have also some funny stuff, very nice. On the platform, when it comes to currency pairs, we have the so-called pips. Let me see. Any other questions? Was everything clear? We have 10 minutes plus before we close this webinar. Do you want me to repeat something, guys? This is time for us to communicate. Any questions or something that wasn't clear? Do you want me to repeat something? Thank you, Vasilis. Thank you for your kind words. Greatly appreciate it. Let's wait a bit more. The leverage, you have to select it upon registration. Once you register, I have, but I couldn't change it in my client portal. All right, this is a question that I can forward to customer support, and for sure they will help you to deal with this issue. They go, I have a question concerning the pair, they go in one direction and not. Basically, they have placed this in this way. The euro dollar is the way that is denoted on the platforms. You can also find it in other like USD and EUR. If you check on some websites, you can find also the base currency being the USD and the counter currency being the euro. Actually, guys, there is no best time to trade. This is just a myth. The best time to trade is when your strategy will give you the best signal. And if you register on Friday's webinar, I can show you a strategy that if you are consistent and you have patience to the settings, you can make really good trades. But being the best time zone, there is no such a thing as best time zone. It's always the best time to trade, depending on your strategy. And sometimes they say that events they influence the markets. It's not the events which they influence the markets as such. It's the people, the banks, the institutions. All of them, they create the directions of the currency pairs, whether it will go up or down. Events are just there to excuse the movements. It happened many times that many people, they were waiting a positive announcement, let's say on the euro, and instead of the euro turning bullish and going upwards, gaining value, it went the other way. I'm not a believer of events. Yes, events, as I said, they excuse the movements. Because the movements, if it's about something to happen, it will happen. It's just a movement takes place, and then they say on the news, because of this event, that's why the euro went up, that's why the euro went down, and so on. But the movements are actually influenced by the retail traders, by the banks, by hedge funds. So these are the players which they influence the market. It reminds me of when Obama got re-elected the second time. Everybody was expecting that the dollar will gain value over the euro. In other words, that the euro dollar will drop. But the other scenario took place. The dollar weakened and the euro strengthened. So this is an indication that it's not the time zones that make the difference. Time zones are just there for you to know which markets are opening and closing during different time intervals. In this related to pair, please provide an example on Euro GBP. Okay, let's go back. Hold on a second. One minute. Okay. Let's see here. Let's find the relevant slide. Let's assume it is the same euro and sterling. When you invest in lots, they have a small difference. Like in the euro dollar, let's say, the 0.1 lot is $1 per pip. In the euro sterling, maybe it will have a small difference. But let's assume that the euro sterling, if you invest 0.1, is $1 per pip. So it's the same idea. You invest 0.1 on the euro GBP, you want 50 pips. 50 times 1 is $50 of profit. So for all currency pairs, even if it's euro GBP, euro USD, they all oscillate in pips. 100 pips, it means 1 cent. 200 pips, it means 2 cents. 50 pips, half a cent. So all currency pairs, no matter whether it's a euro dollar, whether it's a sterling dollar or whatever, they oscillate in pips. Was it clear, Angelos? USA start rise interest rate December. Let me read this. Hold on for a second, Bob. USA start. This is a question that nobody can answer. Nobody knows what will happen in the whole of this year. What you should know is to speculate your charts on a day-to-day basis. Because it's easy, let's say, for somebody to give a long-term prediction that in 1 year, the euro dollar will go up by 600 pips. But during this uptrend formation of 600 pips, maybe it went 20 times up and down, up 200, down 200, up 300, down 100. So try to minimize the time frame of your prediction. Don't try to see far ahead. And as I said, news, they confuse the people. News are there to confuse the people. Let's take the example of the Swiss National Bank, where it was the crash some months ago, when the Swiss franc, when there was a crash, let's say, on all Swiss franc pairs. What happened? The Swiss National Bank decided that it will not longer hold the euro. Yes, it will not longer be the safe haven of the euro currency. And one day the Swiss National Bank said, boom, I will crash the market. How could this, let's say, interfere with any news? Because it happened before any news were released, correct? The Swiss National Bank crashed the market with all Swiss franc related pairs within a matter of seconds and minutes. But there wasn't any announcement on that. So you see that news are just there to excuse the movements in the market. So what you should focus on is your strategy and your game plan. And of course, during a hypothetical big event, aggressive oscillations take place so you can make more pips. At what if I open euro, this will transform? Well, it depends. There is a question here. What if I open an account in euros? This will be transformed in US dollars. This depends on your, I think you say when you deposit on the platform, on your trading account, right? Right, Angelos? When you deposit in euros, no, if you deposit in euros, it will be in euros. If you deposit in US dollars, and depending, obviously, there is also some eligibility on this when you deposit in euros to have your funds appear in US dollars. It depends on the functionality of your account, the specifications that exist here in Argusfx. Any other questions? Since I'm having an issue with my internet connection. Now, Angelos, you can hear me? We still have time. 5 more minutes. Any other questions? Was everything clear? Do you want me something to make more clear to you? Yes. Just to remind you, on Wednesday, we have the webinar of choosing your broker wisely. It's a very important webinar to be able to identify what are the major aspects that you should choose when deciding to open an account with a broker. And on Friday, we are going to see a strategy and how to apply this strategy on the chart, just to see that the events just exist in the markets, but they do not actually direct the markets. What directs the markets is your strategy and whether your strategy can identify what the majority of traders will do, and most importantly, what the big banking institutions and the hedge funds will do. This is what will make you money and make you profitable, to be able not to trade on the events, but to trade your strategy and predict what the big guys are going to do next. Do we have any other questions before we? Yeah, guys, it will be really interesting on, it will be a very interesting webinar on Friday, because we're going to talk about practicals. It is an advanced webinar, but still beginners and intermediate traders can join too. Indeed, it's going to be more interesting, and I'm a person that I want to illustrate strategies that they do work, not just to illustrate a chart, and I'm going to show you the way I trade the markets. Any other questions? No more questions? So it means that thank you very much too. It was indeed a pleasure, guys, to host the first webinar for 2016. As I said, really happy that we can communicate together through the webinars. I would like to wish you a pleasant evening and see you all in the upcoming webinars. Thank you very, very much, and bye-bye.